Economic crashes do not only cut prices, they break liquidity, so buyers vanish and value collapses towards zero. You might have good fundamentals, yet markets trade with fear and leave some assets with no real exit. Here are 5 assets that often lose all value during economic stress when normal trading logic stops working. Asset 1 is small cap penny stocks where thin order books turn every trade into a bad deal. When panic spreads widen and quotes disappear, so selling becomes difficult and buying becomes impossible for many. Price gaps down because there are not enough real bids to absorb even moderate sell orders at all. Some companies survive, but the market still prices them near zero until financing returns and confidence comes back. Financing stress raises dilution risk as new shares replace cash, and old holders get diluted quickly each time. Reverse splits can make the chart look cleaner, while real value per investor keeps shrinking behind the scenes. Trading halts worsen everything because a halted stock resumes at unknown prices after bad news for holders suddenly. Delayed filings signal internal problems, and investors punish uncertainty with extremely low valuations during crisis periods right away. In crashes, the problem is not only business risk, it is market structure that fails to clear orders. If you cannot exit smoothly, your theoretical losses become permanent and your capital feels erased overnight for good. Asset 2 is leveraged exchange-traded products that reset risk exposure daily and punish long holding hard always. In calm markets, the product may track well, but crashes create volatility paths that compound losses faster quickly. Daily resets create negative drift when volatility stays elevated, and the underlying index only partially recovers later on. Prices can diverge from expectations because tracking depends on liquidity and efficient arbitrage during stress for everyone. Premiums and discounts may widen when participants step back and authorized trading becomes slower than usual too often. Hold long-term and the structure can drain returns even if the broad market eventually turns upward again. Leveraged products can also magnify margin pressure when you trade derivatives or use margin accounts at scale today. When liquidity is thin, you may not get the execution you expect, and slippage can finish losses entirely. So Asset 2 often loses value not from one event, but from the product mechanics working against you. Asset 3 is speculative cryptocurrencies and illiquid altcoins, where exchange liquidity decides your survival in a crash scenario. In fear, markets traders exit small tokens first and rotate into deeper books that allow fast execution only. If order book depth collapses, your sell orders push price down, while bids remain far below market-wide today. Some coins keep printing trades yet fail to offer meaningful bids, so charts look active, but exits fail. Exchange stress can pause withdrawals, and when you cannot move funds, your losses become locked for many users. Stablecoins are also vulnerable because confidence shocks can break pegs and trigger forced selling across pairs rapidly everywhere. If your altcoin trades only against one fragile stable, your valuation becomes conditional on that peg staying intact. Smart contract or bridge risks can freeze transfers when congestion and audits slow down completely during outages suddenly. Liquidity migration matters too because traders can abandon one pool and concentrate into another at once for you. Asset 3 loses value when liquidity custody and pricing mechanisms fail together in the same moment for most. Asset 4 is junk bonds and unsecured corporate debt, where defaults become more likely fast during deep recessions. Falling earnings reduce cash flow and make refinancing harder just when markets demand higher yields from every investor. Credit spreads widen and bond prices drop because investors reprice the probability of failure immediately across the curve. The biggest danger is that secondary market liquidity disappears, so trades clear only at distress levels for days straight. Unsecured tranches rely on recoveries that are uncertain, so restructuring can wipe holders out completely when credit deteriorates. Even if a company survives, the market may still mark the bond near zero because uncertainty stays long. Bond funds face redemptions and must sell into thin markets, which locks losses and removes optionality quickly always. If coupons are missed, price can gap down, and panic spreads through headlines faster than fundamentals can change. Default swaps and market indicators often worsen before issuers admit trouble, so timing gets cruel for late buyers. So asset 4 can lose all value when default risk meets illiquidity and forced selling at the same time. Asset 5 is a liquid real estate trust and commercial mortgage securities tied to refinancing cycles and rate shocks. Downturns raise vacancy and reduce rent collection, so cash flow cannot cover debt service long for many properties. Refinancing becomes harder because lenders cut leverage and require more equity when risk rises across the whole market. If borrowers breach covenants, special servicers can take over, and restructuring can shift losses downward through the stack. Private trusts may freeze redemptions, so investors cannot sell even when price looks unreasonable to you right now. When selling is blocked, price discovery stops and valuations rely on stale appraisals for months until reality returns. Commercial properties also face tenant defaults and costly renovations, which shrink net operating income quarter after quarter repeatedly. Mortgage securities can delay recognition because workouts and negotiations happen behind closed doors, often before losses become obvious. As the refinancing window closes, liquidity evaporates and investors struggle to find buyers at any price quickly enough. That is how Asset 5 can trade near zero for long periods, while fundamentals change more slowly sometimes. Now, the common pattern across all 5 assets is liquidity, collapse, plus leverage-like behavior that amplifies panic. When spreads widen and order books thin exits fail, and remaining holders get trapped during declines for months sometimes. Volatility mechanics can compound losses daily for leveraged products, even if the index later improves by a lot. Credit events can cascade as one missed coupon triggers selling across bond funds and counterparties in same session. In real estate, trust refinancing delays can freeze valuations and turn long disputes into permanent losses for investors. So your best protection is recognizing these structures before panic arrives and sizing positions conservatively with exitability. If you rely on constant liquidity, then remember crashes can remove liquidity in minutes, not days at all. If an asset requires trust in systems like exchanges or refinancing, it can break when confidence breaks fully. And if an instrument uses daily resets or leverage its path, can look different from the underlying index. In every category, remember this question: can you sell when the market wants to sell back to you today? If you cannot, the chart becomes irrelevant because exit constraints dominate your final outcome during fear-driven liquidation. For survival, focus on liquidity and plain cash flow rather than complex mechanics that hide risk under stress. Like this video and subscribe for more breakdowns so you stay prepared before the next panic begins again.